Okay, so as a self-employed individual, I have a number of expenses and I also pay a lot of taxes. There's GST, goods and services tax. I pay the editor, the researcher, also my videographer, Qatar, very expensive. There's also income tax to be paid. और फिर जो बच गया, that's the money I get to use for household expenses, khana, pina, and of course investing. The sad part is this is not the end of it. The money I make from investing, interest on FDs, dividend on shares, these are all taxed, and so are capital gains, which is the profit one makes from selling different assets like stocks, mutual funds, gold, property, crypto, etc. We'll understand this capital gain part, the tax part of it in this video. I've tried to simplify it as much as I can, but I must say taxation is not at all simple. Just compiling all this information, it took me like a day with different sources presenting different information. So while you consider some of the material here, I'll urge you to do your own research and if possible, do consult a tax advisor. Let's begin. Okay, let's start with equity shares. And as you all know, these are of two types. Listed shares that we purchase via trading accounts like Zerodha, Grow, Dhan, etc. And also unlisted ones that are bought via online and offline brokers. In either case, what one pays as capital gain is the difference between the price at which you bought those shares and the price at which you are selling them. For example, let's say I bought 500 shares of Fortis Healthcare at 500 rupees each on the 1st of August 2024. This is last year. Today, the price is roughly 950 a share. So 950 minus 500 multiplied by 500 shares, this comes to 2,25,000. So that's my capital gain, and it's this money on which a capital gain tax needs to be calculated as per the current tax rules. And how much is this tax? Well, it depends on a few factors, four of them actually. Number one, there's the type of shares, and both listed and unlisted shares, they have different rules not only in terms of the tax rate but also the eligible holding period. Then comes the holding period, and in my case, Fortis Healthcare, because it's listed and because I've held it for more than 12 months, this transaction is tagged as long-term capital gain. Please do note it's 12 months in the case of listed shares, and for unlisted, the holding period eligibility is 24 months. STT or securities transaction tax is also a factor, and depending on whether it's paid or not, there are different tax rules. And finally, there's the amount of capital gain, wherein the current rules allow for a 1.25 lakh exemption per financial year. Let's apply this to my Fortis example, and on my LTCG of 2,25,000, I can avail an exemption of 1,25,000, which takes my taxable long-term capital gain to 1 lakh rupees. 12.5% of that comes to 12,500 rupees. And guys, just to keep it simple, I'm ignoring cess, surcharge, etc. not only for this section but throughout the video. So with surcharge and cess, my capital gain tax will be a bit more than 12,500, but please note, this 1.25 lakh exemption that I mentioned, it's not for every transaction. It's an aggregate number. So if I had sold more shares, let's say I had some 20 lakhs of LTCG, then this exemption of 1.25 lakhs would be on the entire 20 lakhs and not per transaction or per share. इस type के terms and conditions बहुत हैं, and just to give you a flavor of this, look at this table and notice how your taxes change depending on the date of transaction, which is 23rd of July 2024 in this case. This is just a glimpse of how complicated our tax lives can be, and that's exactly where ClearTax comes in. As India's most popular online tax filing service, ClearTax makes this process super simple. Just log on to your ClearTax account, enter your PAN card details, and the ClearTax workbots, their APIs, will then auto-connect with the income tax department to pre-fill up to 95% of your tax information. You can also upload your Form 16 as a PDF, and the platform will fetch all your salary details instantly. For investors under gains from stocks, mutual funds, F&O, etc., just click on Add Details, and here you'll see integrations with 80 plus brokers across stocks, mutual funds, F&O, US stocks, and even crypto wallets. From there, it's almost effortless. Select your trading platform, click on Login and Import, sign into your broker account, and let ClearTax pull in all your transaction data, irrespective of whether it's 5 or 500 entries. There's also a second option wherein you can manually import your P&L statement from the broker platform, and within seconds, your capital gains are neatly classified as long-term, short-term, intraday, even F&O. Just review the information, confirm your deductions, and ClearTax will not only generate a complete tax summary of your income, savings, taxes paid, refunds, etc. But it'll also auto-select the correct ITR form for you and also the best regime so that aapko mile maximum tax refund. And here's the best part. If you've reported any capital or trading loss in the previous 8 years, ClearTax will automatically fetch it and adjust it against your current gains. Then hit the File Now button and that's it. You're done. Simple, fast, and 100% accurate. ClearTax is safe, trusted by lakhs of Indians, and if you're invested in stocks, mutual funds, or crypto, this is one service you don't want to miss. Since the tax season is already upon us, do try ClearTax today. Use my code SNTax to get an extra 10% discount. And as always, the platform link is available in this video's description. All right, let's look at mutual funds. And as we all know, there are equity funds, debt funds, and also hybrid funds, which can be split further depending on the percentage of equity they hold. Now, in case of equity-oriented schemes, so that's these two, the current tax rules on capital gain is 20% for short-term holding, that is less than 12 months, and 12.5% on LTCG. For debt-oriented schemes, the holding period is now irrelevant. That is, irrespective of the period of holding, the capital gains are now taxed as per your tax slab. Then hybrid and different types of hybrid. I've tried to put it all together in this table here. Please pause if you have to, and yeah, I hope this comes out as a nice ready reckoner for you. In addition to all this, there are international funds, and if these are held for less than 24 months, it's STCG. The gains are taxed at the slab rate, and if the holding exceeds 2 years, then the tax is 12.5% without indexation. Okay, next we have the ETFs, the exchange traded funds. And much like mutual funds, we have equity, bond, gold, and international ETFs. I'll take up gold in a separate section, but very simply, equity ETFs, which is generally your Nifty 50, Nifty Bs, Bank Nifty, and a lot of sector and smart beta ETFs which are coming along. All these are treated like listed equity shares, as in there's a short-term capital gain tax of 20% and an LTCG tax of 12.5% with an exemption limit of 1.25 lakhs. Then there's debt ETFs, so liquid case, Bharat bond, etc. These are taxed per the slab rate irrespective of your holding period. And thirdly, there are international ETFs, instruments like Nasdaq 100, FANG Plus, and if they are held for less than 24 months, then these are taxed at the slab rate, while LTCG tax is 12.5% without indexation, and there is no LTCG exemption as well. Okay, now that we've covered this, a parallel question that often comes up is this. What's the taxation on fund of funds? I know FoFs, fund of funds, these are technically mutual funds, but because the underlying asset is generally an ETF, I think it's more relevant for me to explain it here. So the fact is, an FoF does not always get the same tax treatment as the underlying ETF. For instance, in the case of equity-oriented FoFs, the tax on STCG is 20%, the holding period is 1 year, while the long-term capital gains are taxed at 12.5%. Likewise, debt-oriented fund of funds are taxed like debt funds, that is, the gains are taxed per the slab rate. And in the case of gold, the holding period is 2 years, which is also the case for international FoFs with any short-term holdings taxed at the slab rate, while LTCG is taxed at 12.5% and there is no LTCG exemption here. All right, let's look at crypto, or rather virtual digital assets, as our Honorable Finance Minister called it in the Union Budget of 2022. I must say that budget was sort of a landmark moment for digital assets in India, and as a category, VDA comprises of both cryptocurrencies such as Bitcoin, Ethereum, etc., and also digital assets like NFTs, non-fungible tokens, and others. Now, in terms of taxation, any profits earned from the selling, swapping, or spending of crypto assets are taxed at a flat rate of 30%. On top of this, there's surcharge and cess that needs to be paid. Also, no other expenses can be claimed as deductions. So these are things like transaction fees, brokerage, etc. And thirdly, a TDS of 1% is levied on all VDA transfers. This TDS, tax deduct at source, has been applied to ensure better tax compliance and for greater transparency in crypto transactions. In fact, I read somewhere that income tax officers are now being trained in blockchain analytics, digital forensics, and crypto wallet tracing. So if you have any crypto with you, then please pay your taxes. Every household's favorite topic, gold. The last 2 years have been nothing short of spectacular for investors in gold. The prices are up by some 75% on an absolute basis, which in turn might have tempted some of you to redeem or sell your holdings. from a capital gain perspective. And if you're physical gold, then currently all short-term capital gains are taxed per the marginal slab rate, while long-term holdings, which is 24 months and over, is at a flat 12.5% without indexation, and that exemption of 1.25 lakhs, that's also not available. Then we have digital gold. It's the stuff you can buy from many fintech apps, Paytm, PhonePe, even Tanishq. And the taxation here is similar to physical gold. The third investing instrument in our list is gold ETFs. And per current rules, any units held for less than 12 months shall be considered as short term and would be taxed per the investor's marginal slab rates. However, if these are held for more than 12 months, then the gains would qualify as LTCG and will be taxed at a concessional flat rate of 12.5% without indexation and without any LTCG exemptions. Lastly, let's look at gold mutual funds, and unlike ETFs, the holding period here is 24 months. So if any units are sold within 2 years, then it's STCG, the tax slab applies. And for long-term holdings of over 24 months, the gains are taxed at 12.5% without indexation. Okay, let's move on to fixed income, bonds and debentures. And much like shares, the tax applicability, that is the tax on capital gain, is different for listed and unlisted bonds. Let's start with listed. And for bonds and debentures that are held beyond 12 months, and if STT has been paid on them, then LTCG is taxed at 12.5% without indexation. And if the holding is less than 1 year, then it's treated as short-term capital gain and is taxed at 20% if Section 111A applies. Otherwise, it's the slab rate. With regards to unlisted bonds and debentures, if these are transferred, matured, or redeemed on or after the 23rd of July 2024, then these are deemed as a short-term capital asset and are taxed at the slab rate irrespective of the holding period. And finally, let's look at property, immovable property. And in terms of holding period, now there's a requirement of 24 months for the gains to be classified as long-term, which means if any property was acquired prior to the 23rd of July 2024, then the LTCG is taxed at either 20% with indexation or 12.5% without indexation. But if the property was acquired post that, then the LTCG is uniformly taxed at 12.5% without indexation. The STCG tax on immovable property is a lot simpler to understand, and the gains are simply taxed per the investor's applicable slab rates. Alright, so we've covered quite a bit. And with this, we come to the end of our video. As I said, this wasn't an easy assignment. Honestly, I'm still a bit confused. So if I've made any mistakes or there is something useful you'd like to add, then please point out to that respectfully in the comments box below. I truly wonder why taxation is such a complicated subject, but thanks to technology and thanks to the work platforms like ClearTax are doing, at least the filing bit is a little less taxing. So do try out ClearTax. It's a platform that needs no introduction. I've myself been a user for 7+ years, and especially if you're into stocks, mutual funds, crypto, etc., then I'm sure you'll find their integrations extremely handy. As always, the link is in the description. Use my code SNTAX for a 10% discount. Do like this video, subscribe to my channel, and I'll see you very soon. Until then.